Hey there, welcome back to another video from me. Today we'll be talking about a European REIT based in Sweden. It's called Castellum AB. They just announced their earnings reports last Friday, actually also their 2020 annual reports, and I would love to walk you through them and show you actually what I like about this company, how I look at their results, and what I think about their valuation. Hey, but before we start, if you like this channel and if you would like to see more of these videos, just hit the like button and subscribe to this channel, and you will see any upcoming videos again popping up on your timeline. Having said that, let's get into it. So if you look at Castellum, it's based in Sweden. It's the biggest Swedish listed real estate investment trust company, and it has a market cap of approximately 58 billion Swedish crowns. This is approximately 6 billion euros, so to say. As you can see here, their properties are mainly in the category of office space. Half their portfolio is in the office space. Another 20% is from the public sector, 18% from warehouse and logistics, and then they have some small retail and a little bit in the lighting industry. At the same time, it is really a busy bee because Castellum is just expanding and building new properties continuously. And as you can see here on the map, it has almost 22 projects currently in process. It's probably also worth to mention that this real estate was founded in 1993, and it has already 23 years of dividend growth. And this is because it's continually expanding their portfolio and properties, continuously doing targeted acquisitions, spinning off. So it's quite active, and you will see later also how their multi-year performance has been. I couldn't find so many strong competitors in this region. I think Castellum is really beating most of their competition, but we have got their Wellenstam, Bonava, but also in Norway, Norwegian property. I will get back to that later, why I'm listing here a Norwegian real estate company as well. So if we then look at their, their multi-year consistent track record that I want to already touch a bit on, you can really see here that one of the key metrics for them is the property value in general, the property value of the combined assets. And you can see it has been growing up to 103 billion at the moment. And just a decade ago, it was in 31 billion. So this means that in one decade, they almost tripled their property value in their portfolio. And how did it work then from an income point of view? So it went from kind of a 6 Swedish crowns per share to almost 12, so it doubled at the same time. So although their property value has been expanding 3 times over the decade, it was a little bit slower in the net income, but that's okay. It really depends on the business case per property. At the same time, as you can see, how the company measures itself by the asset value, it has been increasing from 80 to 214 over the same time. So this just shows that there's been a lot of value created over the last decade, and the same you see also in the dividend, because it more than doubled over the last decade again. So, this is quite stunning. I think this is really a strong growth in a market that many of us are not so familiar from, specifically not if you don't live in Sweden. And it's one of those hidden gems, in my opinion, in the real estate industry in Europe. So what I would like to do now is show you a little bit some highlights from the annual report from last Friday. I think it is a really well-written report. And what I really loved about it, it's just 35 pages. Not all these glossaries from the blue chip companies that we're used to that have more than 200 companies that drive you nuts. Just 35 pages straight to the point. So let's get into that. So the company calls their earnings report the strong earnings in difficult times for fiscal year 2020. And I think they're spot on because, if you look at last year with COVID-19, of course, it's crazy. And at the same time, I just mentioned to you also that their main business, 50% of it is actually in the property space. Well, good news there. Soon we will read how they were doing there, but this company has been weathering the storm really well. Well, I mentioned already, it's a short report, so I would like to just give you some highlights and also what I like about this report. So if we go to the first page, we will straight away go to the CEO, summary of the year. And what it nicely shows is how their income from property management has been growing with 7%. This is really what you want to measure as a company. It's it's I would say the same as funds from operations, as share used from American companies. At the same time, their long-term asset value has been growing with 10% again, and this is also one of their targets. They want to grow their asset base with 10%, or the asset value over time with 10%, which is quite ambitious for real estate, but they're really hitting the marks here. And last but not least, and this is one of the dividend aristocrats. It's also a Noble 30 member that has already 23 years of increasing dividends, and their new dividend will be 6 crowns and 90 cents, and it will be paid out in an interim dividend and a final dividend in the upcoming year. And I believe their ex-dividend is somewhere towards the end of March. So what is probably important to know straight away in the front page, they highlighted, because what they have done in the last quarters, they are going to merge with Entra. It's a Norwegian real estate company. And this is a big acquisition because Entra has currently a market cap of around 35 billion in Norwegian krone, which is similar to the Swedish krone in valuation. And I mentioned to you earlier that Castellum has a market cap of 58 billion. So that's why this is also considered a merger as such, or I said branded as a merger and not so much as an acquisition, because it's really it is really a large acquisition, the largest in their history. At the same time, a part of that is being funded by a sale of assets. So they are selling a lot of the logistics portfolio, and for a value of 18 billion to Blackstone. The first one will be, the first tranche will be 5 billion. It will be their older logistics, and it will be approximately 20% above their asset value. Well, this is brilliant, right? That you can dispose your assets at a 20% premium. And once the Entra acquisition will be accepted, I think on 6 February, then that means also that they will sell another 13 billion of assets, mainly again the older logistics, to Blackstone. So again, 20% on top of it. So this is a really, really good deal, and this is a really smart move. And I saw somewhere written in the report that it will therefore it will give them 500 million additional to the bottom line. And for me, this is just brilliant. And with the acquisition of Entra, they consider that the new Nordic prime, because it will be effectively almost the largest real estate investor in the Nordic countries. What is also nice, and it was really, really subtle, what the CEO mentioned here, and I love these statements. Regardless, Castellum's financial position after all these transactions will probably be so strong that some form of extra transfer to the shareholders will be considered. So having said that, for me, this means that he's suggesting here an additional dividend, maybe in the upcoming year or the year after, because they are going to get so much cash in with these transactions that they just feel like it's worth, I would say, sharing that with shareholders, because also their cash position itself is really good. So let's, but before we go there, so their cash position is really good. But before we go there, let's also look a little bit at how they have survived the COVID-19 crisis so well. So I think if you go further to page 10 in the report, you will see that they have an average economic occupancy rate of 93%, which is really large. And actually, it was similar to before COVID-19. So it just shows that COVID-19 had hardly impact on them when it comes to vacancy, occupancy. But also the billing rate, and this was actually mentioned already on slide 3, I forgot about that. They have been able to collect 99% of the money, and where they weren't able to connect it, in Sweden, it's really nice that the government is also financing half of it when someone cannot pay their bills. So, I mean, this is so strong during COVID-19 that you could actually say that they had hardly any impact from this. They've managed it so well. And it's just also a result of having such a strong portfolio. It's unbelievable what this company has been doing. They have really high quality assets in a high quality market. So if we then also look at the exposure to the customers from a financial risk point of view, again here it's really safe, because their single largest customer is spotting 3% here, 3%, and I mean, if this one would go bankrupt, it would have to go bankrupt to lose 3% of income. So brilliant, right? This is so well diversified, this portfolio. I mean, it's just kudos to management here. So if we then go to the financial position, let's go further to page 19. You can really nicely see here that their loan to value is supposed to be below 50%. And it is, yeah, it is, I believe, around 48%. I can't see it so quickly, or 41%. So also, again, really safe here. And what loan to value really means is, think about your own house that you have. Not more than 50% should be, of the value of your house should be supported by your mortgage. That's what we're really talking about. If we then go to page 21, there are also some really great financial metrics that are important to them. And I'll zoom in a bit for that. So here you see their financial metric, and it just shows that they have a really conservative approach to management. So loan to value rate not exceeding 50%, interest coverage ratio. It means that they, with their cash flow, they can at least pay twice the interest, and this is what they're doing. They have been 5 times. Yeah, so it's also a result of the low interest environments. Debt average debt maturity at least 2 years, so 3.8 years. So they can manage their debt so well. I'm not concerned at all about this. So having said that, really strong customers, well diversified portfolio, no impact from COVID-19, and a strong financial position. So I'm afraid already that this company deserves a high premium. So let's look into that. So frequent followers will be familiar with my approach to valuating a company, and let's start with their dividend history. So as you can see, 3.7 Swedish crowns were paid in 2011, and now 6.9. It was another increase of around 6-7%, which will be paid in March. At the same time here, you can see their FFO went from around 2 billion to 3.38 billion over time. Numbers of shares have been increasing as well, but that's okay, because they use that to fund some of the acquisitions that they have done. An FFO per share of 12.2. You can see the share price is currently around 209. So this gives a price to FFO of around 17. Now look at here all the green stuff, and this is what I really love about their companies. 20 years dividend growth, 3.3 yield, 5-year dividend growth of almost 8%. The Chowder rule almost 12%. So that's actually quite good. We don't see that so often in this low interest environment. But at the same time, their payout ratios are relatively low, lower than, for instance, a real estate investment trust is supposed to pay out in America, around 85%. So they have enough dry powder left to keep increasing their dividends for the upcoming decade. But at the same time, their revenue has been nicely growing, and also their FFO have been growing. The credit rating is Baa2. This is actually normal for a real estate company, but with the acquisition of Entra, their ambition is also to move it up to Baa1, and that for such a company would be an A-class rating, I would say. I'm not so concerned about debt to equity, because this is probably the metric that doesn't really fit here. We should rather look at the loan to value ratio, which was good. Well, but the last one is the return on equity bigger than the weighted average cost of capital. So they've been really creating a lot of wealth with a 7% premium on top of that. So what does this give us then, in my opinion? I think their fair value is around 190 crowns. So it's, in my opinion, a little bit overvalued now with 209 crowns. But if you look at their share price, this was, I think, a month ago or a few weeks ago, it was around 190. So I think that we will see some volatility still in the upcoming quarter. So I wouldn't be surprised if it hits the fair value. I can tell you, I will be buying this company if it hits this fair value price, because in this case it will be really the mantra, buying a high quality company at a fair price. So this is not like a mediocre quality company where you want to have a large, 20% margin of safety. No, I would consider this one at fair value of 190. What's probably important to say is that the Swedish tax rate is 30%. I know this scares a lot of people, but I would reclaim the money from the Swedish government, because the double taxation treaty says 15%, and I will add the form to the Swedish tax office if you're interested to the description of this video. I hope you enjoyed this video. I actually enjoy making these a lot, and I really enjoyed this time reading their annual report. It was just a breath of fresh wind, 35 pages, straight to the point, perfect for investors. But yeah, if you would like to see more of these videos, then yeah, just subscribe and hit the like button and share some love. I would really be appreciative. And yeah, see you around. Up to the next video.